Welcome back, everybody. Just while we were on the break, I had a question from somebody. Could I explain exactly what is a trade charge in simple terms? Absolutely no problem. So if we go back up here, never mind the word trade charge there for a second. We said, if you have patent royalties. So what are patent royalties? It's where I had to pay a royalty. So I own a nightclub and I'm playing Westlife music. Therefore, every time I play a Westlife song, I've got to pay a royalty for the right to be able to play that song. Okay, so that's what your royalty is. Paying patent royalty. So a patent is where something is, a design is protected. Okay, so it might be a design or a process is protected so that anybody who uses that design or that process has to pay a royalty for it. All right. So I want to use a patent for in my manufacturing process, and I have to pay the owner of the patent for that particular design. I have to pay them a royalty. That's what patent royalties are. When I incur that expense, am I allowed to have a corporation tax deduction for it? No. Can I have any relief for it? Yes. In tax, we give everything a name. The name that we give to the type of relief you can have is we call it a trade charge. Okay. So that's what the term trade charge means. It's the name that we give to the type of relief that you can have for expenditure on patent royalties. So if the person that asked me that question, if you wouldn't mind, just send me a DM there, just let me know if that satisfies your curiosity. Grant, no problem. Okay, so there's an Alexis question there. That's a fun question. I went over time explaining the losses, so I'm going to have to leave that one for you for homework. But it's relatively straightforward. Okay, we're going to go and have a look at the John Field question. This one looks at losses. It gives us an opportunity to be able to explore at least the case one losses. And then while in the same question, we'll go and we'll pick up what about if there's groups, because remember groups were examinable in tax, and then we'll see how those same losses would be used in a group scenario. So for the moment, I'm just going to pull out bits of information and we'll work on just dealing with two different companies. Here's a company that has losses. What can they do with them? Okay. So we've got John, this is from the December 2014 question. What do I need to read? So John, age 48, he's single, he owns 100% personally of the issued share capital of two companies, Piano and Forte. Now, if we were to draw a picture of that, you would have, so here's John. And John owns these two companies. There's Piano and there's Forte. And he owns 100%. So anybody who remembers anything about groups might remember that in order for companies to be in a corporation tax group, there was a 75% ownership requirement. So when we look at that and we say, oh, John owns 100% of Piano and 100% of Forte. So are Piano and Forte in a corporation tax group? Absolutely not. Okay. In order for companies to be in a group, a company must own at least 75% of the ordinary share capital of another company. So we do not have a corporation tax group here. We simply have an individual who owns shares in two different companies. Those two companies will have to submit their own corporation tax returns. Okay. So what are we told about the two companies? John is in the process of selling one of Forte Limited's retail units. So Forte Limited has a retail unit for sale. He's due to sign the contract on the 14th of December 2023, and the closure of the sale is scheduled for the 14th of January 2024. Now, we covered this last week and we talked about the importance of some of the tiny bits and pieces when it comes to our tax scenarios. So can anybody tell me in what accounting period, is it the year ending 31st of December 23 or the year ending 31st of December 24, will that sale be accounted for tax purposes? 2023. So in an unconditional contract, the date of disposal is the date on which the contract is signed. Okay, so John, that gain will crystallize in the 2023 tax year. All right. So they give us information. There's freehold properties, a bit of goodwill there as well. So the total consideration he's going to receive is 360,000. And we're given information down here about its cost. So that's grand. We know we're going to have to calculate the gain on disposal and then adjust it for corporation tax purposes. And that will be in the Forte company. All right. The projected results for the two companies, so I'm skipping bits here, but I just want to pull out so that we can do basic computation with losses in it. So the projected results for the two companies, excluding the effect of the above disposal, are as follows. So they've got case one adjusted profits. Piano Limited has, for year ending 31st December 2023, it's got case one income of 40,000 and it's got a case one loss of 300,000. Forte, for the year ending 31st December 23, it's got case one income of 140 and case one income of 200,000. Never mind all of this stuff for the moment. Okay. In part B of the question, we're asked to calculate the projected corporation tax liability of Piano and Forte for the years ending 31st December 23 and 24 after any available loss relief if the company structure remains unchanged. So if John continues to own the shares in each of the companies himself, calculate the corporation tax liabilities of each company. There's 4 marks going here for this. Okay. And you're asked to calculate the projected figures. You weren't even asked to give any, were you asked to explain as well? Calculate projected corporation tax liabilities. Yeah, you weren't even asked for an explanation. You were just asked to calculate. All right. Oh, sorry, you were. Look, you were asked to write a memorandum to your tax manager. So if you're writing a memorandum to your tax manager, then there'll be words used as well. All right. In any question, when you've got to give an explanation about calculations, you should do the calculations first, even if the calculations are going to end up at the end in an appendix. Use the calculations first because you get to talk about the calculation in the words part, and you're getting marks for talking about your calculations. All right. So we're going to prepare the appendix first for the corporation tax computations. And we're going to do Piano Limited. So Piano Limited, we've got information about its 2 years, year ending 31st December 2023 and 2024. So let's just start to copy the information down. So I'm just going to hide all of these so that we can see them on screen and make it easy for you to follow along. All right. So we've got, for the year ended 31st December 2023, Piano Limited has case one income. And its case one income is 40,000. And Piano Limited's case one income in 2024 is nil. So as soon as I see that I've got nil case one income in that period, what I want to do is I want to open up a loss memo. My case one loss is 300,000. Okay. I have some more work to do. So, did Piano Limited have any, was it Piano that sold the asset? No, it wasn't even Piano that sold the asset. Piano doesn't have anything else going on. So what can I do with this loss? Well, under section 396A, you can use that loss against any other case one income in the current period. Does Piano Limited have any other case one income in the current period? No. Then you can use it under section 396A against case one income in the immediately preceding period of the same length. Okay, so does Piano Limited have any case one income in the immediately preceding period of the same length? So what's that mean? It means that the accounting periods must be the same length. So year ending 31st December 2024 is 12 months long. Year ending 31st December 2023 is 12 months long, and it is the immediately preceding accounting period. So we can take some of those losses back and we can offset it against that case one income. How do we do that? We take 40,000 of the losses, we bring it back, section 396A. So euro for euro, we're offsetting that case one income. What is wrong with you? Equals that. Oh my God. There we go. So under section 396A, we're taking some of that loss, we're bringing it back against the case one income, and note that it's just a straight offset euro for euro. Okay. What else can we do with those losses? Well, under section 396B, Piano Limited can offset it against its corporation tax liability in the current year. It doesn't have any corporation tax liability in the current year. It can take it back against the immediately preceding period of the same length and offset it against its corporation tax liability. It doesn't have any corporation tax liability. So those 260,000 of losses are now going to be carried forward. What is going on with my spreadsheet? There was gremlins in my spreadsheet during the break. So this is an advanced tax question you're asked. How can you use the losses in each company if there's no changes in the structure? So there we are, we've claimed maximum loss relief. The CT liability for Piano Limited is nil. So when we add up its taxable profits, there is no profits because we got rid of them with the loss relief. Therefore, CT liability, nil. Anybody, any questions on that? Because you were asked to write a memo to your manager, you would have to give an explanation. So here's the explanation here's what I would have put into my words. This would have been in my appendix. And here's what would have gone into my memo. So you can see I've just used my words to explain what was going on here. The extra bit you see in here is that because this 40,000 has gone back to the 31st of December 2023, Piano Limited will already have paid tax on that 40,000 at 12.5%. So it will now get a refund of that tax. And then there's 260,000 carried forward. So before we look at Forte Limited, does anybody have any questions? No? Okay, so Forte Limited, their year ended 31st December 2023 and 2024. There is case 1. And I'm going to hide the rows with piano on it so that we can see the numbers. So here was the numbers up here. Case 1 income is 140,000 and 200,000. Forte is also selling assets in 2023, so it has a chargeable gain. And we'll need to do a working for that chargeable gain. There's the premises. So consideration, what we were told was the consideration for the disposal of the asset is 360, of which 320 is for the freehold property. And the cost of the premises, so Forte Limited bought the premises on the 30th of November 2020 for 100,000. I think I included somewhere in the requirements that you can ignore indexation. So base cost. So sometimes your exam question tells you ignore the indexation just because they're not willing to give you the marks for multiplying it by a figure. There's no other reason here for ignoring the indexation except I couldn't be bothered. Okay. So we've got a gain of 220,000 on the disposal of the premises. As far as goodwill is concerned, goodwill consideration is 60,000. Base cost, anybody tell me what's the base cost of goodwill? Zero. Very good. Yep. So goodwill is internally generated. We didn't buy that goodwill. We generated from carrying on the business successfully. So we've got a gain on disposal of the goodwill of 60,000. So the total capital gains $220 plus the 60,000. And that's capital gains. We need to, was it, 40, thank you. There we go. So we need to multiply that figure by 33 over 12.5 to adjust it for corporation tax purposes. So CT adjusted. So to adjust for corporation tax purposes, we're multiplying the gain by 33. We're dividing it by 12.5. That gives us 686,400. And in Forte's corporation tax computation, we're going to put in 686,400 of a gain. And then we're going to tax that gain at 12.5%. Okay, so anybody, any questions on that bit? No? Okay. Because we're writing a memo to our manager, we'd have to use our words to describe what we've done. Okay. So to use our words, so this would be in the appendix. And in our memo, we'd have for Forte Limited, first thing to remember is that I made a decision on the timing of the disposal. And I said, that's a 2023 disposal based on the date the contract was signed. Okay. So I need to put that into the words in my memo to my manager. And then I'm simply using my words here to say the corporation tax liability are those figures. Have a look at my appendix. Okay. So that's the wording that would go into my memo. But just to address the question in the chat there, can you transfer the loss? So you're asking me about the loss that, and I'll just unhide all of these again now. So the loss that was sitting there in piano of 260,000 and it's not used. So I'm effectively been asked, why are we not able to transfer that loss? Because they are not in a group. So what's his name? John. John owns the shares in Piano and Forte. You've only got a corporation tax loss group if a company owns the shares. So does a company own the shares in a company? No. Is it Eleanor? Am I pronouncing your name correctly? Yeah. Okay. So I deliberately drew a picture that looked like, well, that looks like a group because you have shares owned and you've got these two, and there's a relationship between them. It's not a group because a company must own shares in another company in order for it to be a group. Okay. So there's how losses were tested. Now, what I wanted to just see is have a look at, so you were asked to write a memorandum to your manager for 4 marks with those calculations and just, put in the words as to what's going on. Okay. You would not have got 4 marks for that much work in the taxation paper. Okay. The next part asks you to evaluate the advice received from Mark Meadows, making recommendations as appropriate. And there's 7 marks there. So there's some advanced elements there that I've kind of chopped out because that relates to clawbacks and reorgs. Okay. But we will have a look at the advice received from Mark Meadows. Before we do that, what I want to have a look at is the proposal is that in D, we recalculate the CT liabilities of Piano and Forte Limited for the years ended 31st December 23 and 24, assuming that the advice received from Mark Meadows, as amended by your recommendations in Part C, is implemented together with the resulting saving. So let's have a read of what Mark Meadows has said. Before we even read what he has said, can anybody identify what we need to do to be able to utilise those losses?
We'll transfer ownership of two companies into a holding company so they both
Yes.
end up then.
So we need to have a group in place, don't we? How we do it, whether we put a holding company in place or if we just get one company to buy the shares in the other company, once there is a group in place, as soon as we have a group, then those losses can be surrendered. The rules as far as group relief and how group relief works will still apply, but those losses will be surrendered. So very quickly, just before we attempt that, let's go and revise. So exactly like I said to you, when you're doing questions, if it's something that you haven't come across since you did at taxation level, go and revise it. So what does it tell us about corporation tax groups? Only looking at the corporation tax groups. So for the loss group definition, your parent company has a direct or indirect effective 75% in a subsidiary. And it must be shares, rights to profits and assets. It must be full ownership of the company. Okay. We don't need to worry about this second condition because both of our companies are Irish resident. So once we get them into a group, i.e. that there's at least 75% ownership, then group loss relief will apply. And group loss relief says under section 420A, and again, the section numbers help us because we know where do all those A claims go? They go up against case one income. Where do all those B claims go? Those B claims go on a value basis. So under section 420A, we can take a current period trading loss or current period trade charges, and we can surrender them to the same current period to be used against relevant trading income. So very, very important. When you surrender losses to another group company, you can only surrender in exactly the same periods as the loss arose. You don't get to bring them back in the other group company. Under section 420B, we can take current period trading losses or trade charges, surrendering them to the current period only on a value basis. So that means they're going to be able to give the losses to another group company to use them in the same way that I use them under section 396A, but only in the current period, in the same way that I use them under section 396B, but only in the current period. Yeah, that's exactly it. If there's any left over, can I surrender them to the other group company to carry them forward? No. So the company that you surrender the losses to can only use them in that same period that the loss arose. Can't go back in that recipient company and can't go forward. Only the loss-making company can take losses back and forward. Okay. So what else do we know down here? Losses can only be surrendered to the extent they can be absorbed by the claimant. Only current year losses may be surrendered. No relief for case 5 losses, not relevant to this question. The accounting periods of the two companies must match, otherwise time apportionment will be necessary. We see in our question both companies are preparing their accounts to the same year end, so it won't be an issue. Where one company pays the other for the benefit of the relief, that payment will not be taken into account. There's no mention of either company here paying for the benefit of the losses. Losses in an EU, EEA or UK company, both these companies are in Ireland, so that's not relevant. And then the time limit for claiming group relief is 2 years. So I've revised everything I need to know in order to be able to address this question. Okay. The only difference here is The group hasn't yet formed. So what we have to do is we have to look at what is being suggested as to how the group is being formed and make sure that when that's done, we will be able to use the losses under section 420A and 420B. All right. So what does this Mark Meadows fellow tell us? So John is keen to make the maximum possible use of the projected losses of piano. He recently discussed the issue with his cousin, Mark Meadows, a trainee accountant with a rival firm of accountants. So the poor old trainee accountants and retired accountants get terrible abuse in exam questions. He received an email from Mark after having this conversation at the family wedding, where Mark, the trainee, bless him, outlined some tax advice. The current structure does not allow for the transfer of losses from piano to fort. Is Mark, the trainee, right? Yeah. So under the current structure, you can't transfer the losses. Do I get to say that in my exam? Absolutely. You're going to be writing words where you're asked evaluate the advice. So Mark is correct. Under the current structure, the losses cannot be transferred from piano to forte. Okay. The substantial capital gain will arise in 2024 upon the closure of the deal to sell the unit. Is Mark correct? No. And this is all assumed knowledge brought forward. Mark, you are not correct. The closure of the deal is in 2024, but the date of disposal is the date the contract is signed. So in our memo, we need to call out, Mark is wrong. The capital gain takes place in 2023 and not 2024. Okay. Now, we're trying to create a scenario where there's losses in 2024. We want to form a group so that the losses can be surrendered to the other group company. So we're going to put piano and forte in a group. And when we surrender the losses to the other group company, they will be surrendered into 2024. What year does the gain arise in? 2023. Is there any advice we could give to John to force that gain to crystallize in 2024? Yeah, don't sign until 2024. So when are you planning on signing the deal? You're planning on signing it in, where is it gone? John's King, where is he? 14th of December. Sure, it's Christmas, and with the Christmas parties, you won't even notice that you haven't signed the contract. Sign it on the 1st of January, and now your disposal happens in 2024. Happy days. The gain will now be in 2024, and we'll be able to use the losses against the tax liability arising on that gain. Okay. So that's that bit. You need to form a 75% group on the 1st of January 2024. So yes, a 75% group is, there must be at least 75% ownership of either piano owning forte or forte owning piano, or a third company, a holding company, owns 75% of both companies. All right. There's an advanced tax aspect to this where we'll be saying, actually, you should make it more than 75%, but we're not going to worry about this now. That's why I don't want you going looking at solutions, because I want to bring this back to what we have as assumed knowledge only. Okay. So yes, Mark is correct. You want to form a 75% group for the purposes of being able to surrender the loss relief. He says the full amount of the trading losses in piano can then be surrendered to Forte Limited to shelter its chargeable gains and profits. No, Mark, you're wrong. You said that the gain was going to arise in 2024. If the disposal is not deferred, the gain will arise in 2023, and you won't be able to bring those losses back to 2023. Okay. Forte can become the parent company of Piano. So he's suggesting that, you know, Forte buys the shares of Piano. Will that make them a group? Yes, it will. We don't need to worry about the share exchange here. That's the advanced tax bit. Okay. So all we're doing, so we've evaluated the advice. I'm going to drop the answer in because we know our recommendations are simply that we so Eleanor, I'm not sure what question you're asking me. Okay, so you're told today is the 1st of October 2023. All right, and we're trying to do some planning for 2024. So what we want to make sure is that the group happens at least from the 1st of January 2024. Is that what you're asking me? Or are you asking me an if scenario? So a company can join. I'm trying to figure out what you're asking me. So I'll kind of answer the question that you're asking me.
Yeah. Yeah. What I ask you is about, for example, in this group, I plan to do everything the 1st of January. For any reason, we have a problem, and the company started to be as a group like in March 2024. Is allowed, or like there is a limit? You have to be the full year, or you can be like 8 months old, and then you're eligible to apply it.
So the group can be formed on whatever date you like. It doesn't have to be the first day
Okay.
of the accounting period. Okay.
Mhm.
You can form a group on any day of the year you like. However, when you're surrendering the losses, you can only surrender the losses that were incurred during the period that those companies were a member of the group. So
Okay.
if the company joined on the 1st of March, then there would only be 10/12 of the losses that could be surrendered, or 10/12 of the relief availed of.
I got. Okay. Thank you.
No
Thank you
problem.
so much.
So back here, so I'm just going to drop in the recommendations because they're pretty much what I stated there. We read down through it and we were able to identify, apart from the advanced bit around the group reorg, yeah, drop them in there, yeah. The only thing that we're going to say is, yeah, go ahead, set up a group on the 1st of January, but we're also going to defer the signing of the contract until the 1st of January 2024. Okay. So now we have a group, and we now need to redo all of the corporation tax computations. All right. So we will have Piano Limited, and Piano Limited had its case 1 income. So you could literally just copy it down from the information that we had earlier on. Then it had its loss memo. Move mouse. So there is the loss memo with the case 1 loss of 300,000. All right. Before losses can be surrendered to another group company, the loss-making company must use its own losses to the maximum extent possible. Okay. So I often liken it to, it's a little bit like Easter Sunday. If you remember when you were a kid and you got Easter eggs, And perhaps you were one of the lucky ones and maybe you got 10 Easter eggs. And if your sister or your brother said to you on Sunday morning, on Easter Sunday morning, can I have one of your Easter eggs? You would have said no, and you would have put all your arms around your Easter eggs and said, no, I'm not sharing. Okay. But after eating 2 or 3 or 4 of your Easter eggs, and maybe by the afternoon, and you're so sick of the chocolate that you just cannot take anymore. And then your sister says, can I have one of your Easter eggs? Oh, go on, which one do you want? All right. So surrendering loss is a little bit like giving away Easter eggs. You don't give them away until you're so full up with them that you can't take any more. All right. So piano has to use its own losses first to the maximum extent possible before it can surrender. All right. So Piano Limited is actually going to be exactly the same position as it was before. Okay. So there is the loss offset against Piano Limited's profit. Piano is still going to get its 5,000 refund. Okay. How much losses were left over? 260,000. When Piano wasn't in a group, we said, tough, that's carried forward, ring fenced to income of the same trade. Now that it's in a group, that's available for group relief. Okay. And because it's available for group relief, we can then go and surrender it to our group company. Who is our group company? The other company, Forte Limited. So let's just get the information down about Forte Limited. So we know Forte Limited had its case one income of 140 in 2023 and 200,000 in 2024. Under section 420A, we can surrender some of Piano's losses to Forte. So I'm putting into the note here, this, I'm applying the rule. This is the rule. You can only surrender it to the same period. It can't go back, right? I'm still asked to do the computation for the preceding year, but I can't take those losses back. So how much losses are we going to give Forte? We're going to take 200,000. And that 200,000 is offset euro for euro against the case one income. So now total income in Forte in 2024 is nil. Don't forget there was the chargeable gain. And remember, we gave advice to defer date of contract. So that meant that the gain goes into 2024. So that's 686,400. Let me do all my little rows. So we've got total profits in Forte Limited of 140 and 686 400. Corporation tax at 12.5%. And then CT at 25%. So this 686 400, that is the chargeable gain, and that's taxed at 12.5%. This 140,000, that's case one income taxed at 12.5%. So I'd no income at 25%. That's grand. So Forte Limited is a group company. It has a corporation tax liability. There's the other group company that has another 60,000 of losses left over. What can we do with them? We can surrender those on a value basis. So under section 420B, so remember, surrendering losses can only go to the same period. So how much losses are left? 60,000. So we're going to take all of that 60,000. Sorry, this is wrecking my head. There we go. We're going to take that 60,000 offsetted against Forte Limited. When we're using the losses on a value basis, you take the amount of the loss multiplied by 12.5%. Because remember, value basis gives you the value of the tax saving. Okay. So then you simply had to use your words to explain, well, what is the result of doing all of that? The result of doing all of that is that all of Piano's losses have been used up. There's nothing carried forward. The Forte Limited's tax liability has been reduced. And there is a tax saving of X amount. So I put in, I'll just put in here what my answer, the words I used to describe the workings that I did. And you can see it's just sentences that describe exactly what we did. There's nothing advanced in this. It's just use your words to say what you've calculated in your numbers. Okay, so see, the CT liability of Piano Limited remains unchanged, but I was getting marks for doing an appendix and showing that it remains unchanged. Okay, I had to redo the loss memo, and the balance on unutilized losses of 260 are then surrendered. So there's no losses carried forward. That's what I did up here. I'm getting marks for saying, see what I did? And then the new structure results in a corporation tax saving of 32,500. Where did I get that? Well, I have the corporation tax liability from Appendix 1 for Forte Limited, which was, actually, I don't even need to go as far as that. I can simply look at 200,000 multiplied by 12.5% plus the 7,500. Okay. So, anybody got any questions on that? All right. So this next question here, Paper owns 80% of the share capital of Rock Limited. Paper is a close company. Now, we haven't done close companies yet. The results of both companies as adjusted for corporation tax purposes for the year ended 2023 are as follows. So you've got trading profit, Irish rental income, UK rental income, dividend income, and you're asked for 4 marks, calculate the corporation tax liability. Okay. Do we do this together? So I want to set out computation for each of the companies. Now, if you've got any questions, do make sure you ask me, because wait till you see the humdinger of a question I have for you for homework. And it's all taxation. There's no advanced taxation in it. Okay. So case 1, just taken directly from the question, is 200,000, and for Rock Limited is nil because they have a loss. So I need to open up a loss memo. And what sort of a loss is it? It's a case 1 loss. The amount of the loss is 300,000. What other information did they give us? They told us we've got case 5 income, we've got some UK rental income, so that's case 3. Because I know that there's group loss relief going to be available, I'm going to leave a little bit of space under here. Okay, so I'm leaving a space for my group relief to go in. Here's my case 3, which is the UK rental income. And the UK rental income is 55,000. In paper, then case 5, Irish rental income, 105, and 40,000. Irish dividend income, is that taxable? No. Okay. Total income. And in fact, total profits, because there's no chargeable gains in this question. We'll be adding those up. And then I'm going to tax all those, corporation tax at 12.5%. And then we know we've got corporation tax at 25%. So all I've done there is I've simply copied the information that I got in the question into a template where I'm saying, look, here's all the income, here's the losses, and I now have to decide how I'm going to use those losses. Right? So what are the rules? The rules are case 1 loss is used in the loss-making company. In the loss-making company under section 396A against case 1 income in the current period and back against the immediately preceding period of the same length. What do we do about the fact that we've only got one period here? We just assume there's nothing in the preceding period. Okay. So under section 396A, in both the current and the preceding period, will Rock Limited be able to use its own losses? No. How else can Rock Limited use its losses? It can use its losses under section 396B in the current period. On a value basis. Now, before I can work out how much losses it's going to take, don't I need to calculate the tax first? So this is where losses become a little bit like, it's like Sudoku, that you have to keep going back and forward between the corporation tax computation and the loss memo. So I need to calculate Rock Limited's corporation tax liability. That 40,000 is taxable at 25%. Why? It's case 5 income. So Rock Limited has a corporation tax liability of 10,000. How much losses will it take to get rid of 10,000 of a tax liability? So here's where you need to look at your formula. I want losses multiplied by 12.5% equals 10,000. So how much losses multiplied by 12.5% equals 10,000? Well, if you take 10,000, divide by 12.5%, that gives you the amount of the losses. So 10,000 is the amount of the tax liability. Divide by 12.5%. And that gives me 80,000. So I need to take 80,000 of losses. And when I multiply that 80,000 of losses by 12.5%, that gives me the value basis relief for Rock Limited. So before we go any further, anybody got any questions on that? So for anybody who is exempt from F6, this is an easy question in F6, and groups are examinable, not F6, sorry, the taxation paper used to be called F6. Okay. So this would have been an easy question, probably for about 6 marks instead of 4 marks. So now, these are, Rock owns these losses. Rock has used the losses to the maximum extent possible. So Rock has eaten all the Easter eggs and it's got 220,000 left. And Paper Limited says, can I have some of your Easter eggs? Absolutely no problem. Okay, so there's 220,000 available for group relief. How do we give that group relief? Section 420A. And I'm not going to bother writing in the current period only, because I've only got current periods. There's 200,000 of income, so I'm going to take 200,000. That 200,000, I'm going to use it up here against case 1 income. Does Rock Limited have any more losses left over? Yep, it's got 20,000 left over. Can it give any of that over to Paper Limited? It can. So Paper Limited will still have a tax liability. That 160,000 multiplied by 25% gives you a tax liability of 40,000 under section 420B. Surrendering on a value basis. Here, I don't need to figure out how much losses do I need to take, because I actually don't have enough losses to get rid of all of the tax liability. So here I'm just going to take the 20,000. And when we take that 20,000 multiplied by 12.5%, that gives us 2,500 of value basis relief for Paper Limited. So this is why when we spoke last week, we said the importance of actually refreshing all of that assumed knowledge. Even if you did the taxation paper, even if you did it relatively recently, in order for you to be able to look at these questions and know what's going on at a basic level, so that when I come along and I say, oh, by the way, R&D tax credits are also available, or also we've got close company surcharge, you don't want to be stuck at a stage where you're going, oh, Sandra, hold on, wait, what did you do with the loss? Why did you multiply that by 12.5%? Because what I'll be saying to you is go back and watch the first two night sessions. We don't have time in the main course to reteach the taxation syllabus. All right. And I hope that didn't sound cross when I'm coming across when I say that. It's very important that we cover the entire syllabus. You don't want to be going into the exam going, hope such and such didn't come up because she didn't have time to cover it. She spent so much time explaining the basics, redoing what we were supposed to have done in the previous course. Okay. So for that reason, actually, sorry, I forgot to put my section 40. I went off on a rant. There we go. That should be just down there just to show the different section. So for that reason then, because we know that this stuff is assumed knowledge, does form a very important foundation, and we're going to be building on that. Not necessarily from week one. So what we're going to do is from week one, we're starting with a brand new tax. So what that means is that you've got a couple of weeks for you to be refreshing all of the stuff that we've covered in those 2 nights before we get into bringing forward all that assumed knowledge to a greater extent. Okay. All right, I do want to pick up a little bit of that. And mostly what I'm going to do is talk about cross-border rules, but your homework question. All right, please don't hate me. I found this question. It's a humdinger. But if you work your way through this question, you will be able to understand. It doesn't it look fabulous? Now, when I say it's a humdinger, there's nothing in it that's advanced tax. It's all from the taxation paper. Okay. But it will illustrate to you the importance of understanding what we covered, what was covered in those papers, whether you were exempt, whether you studied it 40 years ago, or whether you have just studied that subject more recently. It's assumed you know that stuff. Okay. Now, I've said, do not look at the solution. The layout is more difficult to follow than to just figure out the loss reliefs for yourself. I will do up, so I've given you a template. All right. So to make it a little bit easier, and I will do up a solution then. It won't be there tomorrow. It'll be there before the weekend. I'll do up a solution where it has a step-by-step explanation on, oh, I did this, and I did this, and I did this, and I did this. Is that okay? Yeah. All right. So this is for your own good. So it's like your mommy when you were a child giving you the cod liver oil and you were going, she was literally having to hold your mouth open to shove it down your throat, but it was for your own good, because look at you now, you're flying around, not a bother on you. All right, let's go back and I need to pick up a little bit of VAT. Now, I don't need to do as much of the VAT stuff brought forward to build on, but what I will say to you is there's some basic stuff that comes up in VAT for really easy marks that we're not even going to look at in the advanced tax course. So what I don't want anybody thinking is we're not going to cover the course. if it's taxation assumed knowledge, for example, let's say there's a trader takes goods from the business for their own private use. All right. I won't be covering that in the advanced tax course. That was on the taxation course. But if that comes up in your exam, you needn't say she never covered that, because I'll be saying, oh no, it was on the taxation course. Okay. So we've got these notes to help you. Like, we've just taken the main parts of the VAT course and pulled them all together just in some summary notes. If you need more, if you're struggling on some of the basics, come talk to me. I'm going to spend a little bit of time talking to you about cross-border rules, because that's the thing that tends to come up. And then I will flag some questions and you can go and have a look at these questions, make an attempt at them. They are short questions for only a few marks, and you can self-correct on those. Okay. So the first part of your VAT notes, this is on page, whatever page this is. I didn't put page numbers on it. Well done, Sandra. This is the bit value-added tax. Page 28. So the first bit there is about kind of, when VAT applies, what's within the scope of VAT, the different VAT rates. What's the difference between zero rated and exempt? That's going to take on so much more importance when we get to dealing with VAT on property, which is an advanced tax aspect. Okay, the whole kind of, when you make an exempt supply, what are the consequences from a VAT perspective that will be important. So exempt means VAT is not charged, you're not allowed to charge VAT. Because you are not allowed to charge VAT, you don't get any VAT recovery on the related input costs. Okay. Zero rated means charge VAT. What rate do I charge VAT? 0%. How much VAT is that? It's €0 VAT. Are those two things not the same, Sandra? No, they are completely different. So zero rated means we did charge VAT, so that makes it a taxable supply. And because it is a taxable supply, we get full VAT recovery on related input costs. Exempt, we weren't allowed to charge VAT, so there was no VAT. And because there was no VAT charged, it was an exempt supply, we have no VAT recovery. Okay, very, very important. Thresholds there, I'm not going to spend any time on that. Your VAT pay and file system. Be surprised that the annual accounting scheme and the cash receipts basis can come up in the advanced tax paper. So there's some notes there for you to go and have a look at, remind yourselves what they were. Let me get down to my cross-border rules. We'll be covering VAT on property in great detail and much more advanced aspects, so we could be able to come back to lettings and all of that. Only want to talk to you about cross-border rules tonight. Here we go. So for cross-border rules, what are we dealing with? We're dealing with supplies of goods and services where the goods or services cross a border. Okay. Now, sometimes in VAT, we give things names. And sometimes the name isn't very helpful. So see the name here, or this rule here, dispatched or transported. When we hear dispatched or transported, we think, oh, it was put up on a truck and it went from place A to place B. No. Dispatched or transported means it crossed a border. All right. So if we've got goods, if you're told in a question, Larry in Dublin sold goods to a customer in Cork, and the goods were dispatched and transported to the customer in Cork. Is that a cross-border supply? No, that's an Irish supply. Irish VAT applies. I don't need to figure out where the place applies because it happened in Ireland. So what dispatched or transported means, it's not the general interpretation of the words, it's that the goods were dispatched or transported across a border. So if you want to write that on top of that for yourself, it means that they went across a border. All right. So when goods or services go across a border, and first we're going to start talking about goods, what we need to do is determine what's the place of supply, because the place of supply determines in what country VAT must be charged. Okay? So the general rule is that if goods are not dispatched or transported, so they do not cross a border, the place of supply, so that's telling you what country you must charge VAT in, is where the goods are located when the supply is made. So the Larry example that I had earlier on, the goods went from Dublin to Cork, where they dispatched or transported. No, therefore, the place of supply is where the country in which the goods were located. What country was that? Ireland. So Irish VAT has to be charged. Okay. Where goods are dispatched or transported, the general rule is the place of supply is where transportation begins. So where they do cross a border, so the goods went from Ireland to France. Where did transportation begin? Ireland. So the place of supply is Ireland. Therefore, we charge VAT in Ireland. What rate? There's a rate specific to supplies between taxable persons within the EU. Okay. So if the goods are supplied from an Irish VAT registered business to, say, a French VAT registered business, then the place supplies where transportation begins, and Irish VAT is charged at 0%. All right. Now, there's different rules that would apply where we sell goods to private individuals, but we're not going to worry about those because they're tested less at the advanced tax level. It's more likely going to be the supplies between businesses. Okay. So that's your general rule. There are some exceptions. Now, there'll be more exceptions that we'll add on top of this. So that's why I just want to go back over the general rules. So one of the exceptions to the general rule is that where goods are installed or assembled, the place of supply is where the installation or assembly takes place. An example we've got here is you've got a German supplier installs machinery in Ireland. The general rule would have said, see that machinery, was that dispatched or transported? Yeah, place supplies where transportation begins. That's German. But because it was assembled in Ireland, the place of supply now switches to Ireland. So that's what exceptions do. They switch the place of supply from the general rule to a different VAT treatment. Okay. For cross-border trade, it's important to understand, again, the terminology that we use in VAT. It's not the same as the layman's language. So if I said to somebody that, oh, I'm importing goods from France, if they weren't a tax person, they would know that I just buy stuff in from France. Or even if I just said to them, I import stuff from all over the world, they wouldn't care what country I was importing from. But if you say to a tax person, I'm importing goods from all over the world. Okay, what countries are you importing from? Oh, well, I import from the US, China, France, and Germany. No. You import from the US and China, but you make intra-community acquisitions from France and Germany. Okay, why? The different treatment that we need to worry about. All right. So that's why we've got these different terminologies. So imports is the acquisition of goods from countries outside the EU. Same with the word exports. When we think of, layman's term, export just means you're sending goods from Ireland to anywhere else in the world. No. If you're sending the goods from Ireland to a country outside the EU, that's an export. If you're sending the goods from Ireland to a country within the EU, that's an intra-community supply. Okay. Why does it matter whether it's intra-community in the EU or not? Okay. Well, because this sales tax system operates across the whole of the EU. It's an EU-wide sales tax system. Okay. And most of the large proportion of the VAT laws in each country actually come down from the EU by way of regulation or directive. Okay. So that's why it's important what country we're buying and selling to and from. So there's information there about, you've got imports into Ireland. So what's the general treatment? So when there's an import, usually those goods are stopped at the docks, and Irish VAT applies at point of entry as if the goods were bought down the street in Ireland. So same rate applies on imports at point of entry as if you went and bought them in Ireland. Okay. Exports out of Ireland, 0 rate. So if I'm exporting, let's say I'm exporting shoes, okay, they're adults' shoes. And not exporting, sorry. Yeah, it applies to all exports. So I'm exporting to outside the EU, or I'm making an intra-community supply to VAT registered persons. In both cases, the VAT rate I charge on those shoes is 0%. If I sell those same shoes to a customer in Kildare, what rate of VAT will I charge? 23%. Okay. So goods that will attract a VAT rate of any of the rates, whether it's 23, 13, 9 in Ireland, once they are either exported or supplied in an intra-community supply, the VAT rate goes to 0%. And the purpose of that is to allow for the freedom of movement of goods throughout the EU. Okay. For your intra-community supplies, so this is a dispatches where you make a supply, where the goods are dispatched from Ireland to a VAT registered person in another EU member state. The place supply where transportation begins. VAT rate is 0%. Very, very important. In order to be able to apply the 0% rate, you must quote the customer's VAT reg number on the invoice, and you must retain evidence of dispatch. You don't need to do that for an export because the customer is outside the EU. They don't have an EU VAT number. All right. For intra-community acquisitions, very important. General rule is goods acquired in Ireland by a taxable person from another EU member state, so from a VAT registered business in another EU member state, the place of supply is where transportation ends. And the customer accounts for VAT under the reverse charge mechanism. So let me just explain this for a second. Listen here. So I'm not going to get near any of these questions, but I will leave them for you to have a go at. So we've got Paddy. He is Irish VAT registered. Purchases goods from a German VAT registered business. And we're asked, what is the VAT treatment? So Paddy wants to know, what's the Irish VAT treatment? What's very useful for you to understand is that the rules are effectively a mirror image across each of the across the EU. Okay, so the German supplier, what is he doing? He's making an intra-community acquisition. Okay. And in Germany, what is the treatment? Sorry, not an intra-community acquisition, an intra-community supply. Sorry. So in Germany, the VAT treatment, now you're not going to be asked foreign tax rules. I'm giving you this example so you can understand that the mirror image that's happening with intra-community supplies and intra-community acquisitions. Okay. So in Germany, the VAT treatment is that the place of supply, so POS is just short for place of supply, is where transportation begins. Where does transportation begin? Germany. So charge German VAT. Okay. What rate? 0%. Are you sure? Do you not need to go and look up the German VAT rates? Nope. 0%. That's what they will be. That's what the German VAT rules will be. Charge 0%. But the German VAT rules will also say that they will have to quote Paddy's VAT reg number on the invoice. Okay. So that's the German supplier. Then in Ireland, so Paddy, he's the Irish customer. What's Paddy doing? Paddy is making an intra-community acquisition. Okay. When he makes that intra-community acquisition, so in Ireland, the VAT treatment is that, again, determined by reference to place supply, because once goods cross a border, we need to determine what's the place of supply. The place of supply is where transportation ends. Oh, where's that? That's Ireland. So, charge Irish VAT. Paddy's saying, who me? Why didn't the German fella? No, Paddy, you're here in Ireland. You're already registered. Charge yourself VAT. Charge myself VAT. Oh, okay. What rate should I charge? Whatever the Irish rate is. Okay. Oh, where do I put that? You put it into your output VAT. It's reverse charge. Now, what you might also have to let Paddy know, because Paddy will want to know, see that VAT that I just charged myself. Can I recover that? Because I had to actually take that out of my pocket and pay it over to revenue. Well, it depends. What are you using those goods for? Oh, well, I run a college. I'm sorry, college is exempt activity. You're using those goods for exempt supply, no VAT recovery. Or I run a, brain has gone blank, a grocery shop. Oh, do you have, are all your supplies taxable supplies? Yeah, they're all taxable supplies. Oh, well then you can have full VAT recovery. And in those circumstances, it's an in and an out. But so many times I hear students saying, this reverse charge stuff, that's just an in and an out, isn't it? No. It's never an in and an out until it is an in and an out. You've got to go through the motions first. Where's the place supply? Wherever transportation ends. Where's that? That's Ireland. Okay, charge Irish VAT then. What rate? Well, what rate do you charge when you buy that stuff in Ireland? Charge yourself that rate of VAT on a reverse charge basis. But I'm incurring a cost. Yep. Can I recover it? It depends. Okay. Now that bit is the bit of cross-border rules that so many students fall down on. And what you'll find is the questions that I selected, in how many questions have been in there? 3 questions. So there's 3 questions in there, and you'll see, I think the cross-border rules came up a couple of times. Okay. I've 5 minutes left, so don't worry about intercommunity distance sale of goods. Let's take the couple of minutes left to talk about the cross-border or the place of supply of services. All right. So for place of supply of services, you have different rules. These rules that we talked about up here, these were the rules for goods crossing a border. Place of supply for services, you've got your general rule, and they're referred to as the B2B and the B2C rule. For the B2B rule, place supply is where the business customer is established. Okay, so you've got business to business. All right. So that business there helps you to find out that it's the business customer. Wherever the business customer is established, that is where the place of supply is. Okay. So Paddy has an Irish business and he provides services to a business in France. Place supply is where the business customer is established. Where is the business customer established? France. Does Paddy charge Irish VAT? No, you're right. Okay, so no Irish VAT is charged. All right, it's not a supply. If the place supply is not Ireland, there is no supply. All right, next one we have then there is B2C, and B2C is business to, this C is for consumer. So your B2C general rule is the place supplies wherever the supplier is established. So think about it for a second. If a business is supplying services to a consumer, they could have consumers all over the EU. It would be ridiculous for the supplier to have to be registered in every single country in which they've got a customer. So doesn't it make sense that you just charge the customer your home country VAT rates? Okay. Administration of cross-border. So this comes up a couple of times in, I think this came up in one of the questions there that I had intended to do, but I let you do them for homework instead. So your section 56 authorization, where this applies, what this does is it gives the person who has this authorization the ability to be able to buy goods and services and not be charged VAT on the goods and services except for non-deductible items. Okay, so for the conditions to be satisfied are that they must have 75% of their turnover from exports, intra-EU supplies or contract work. So effectively, that type of turnover will all be 0 rated, and this type of taxable person will most likely be in a constant VAT repayment situation. Okay, so what this section 56 authorization does is it says there's no point in you being in a constant VAT repayment situation. What we'll do is we'll give you an authorization that you can give to all your suppliers, telling all of your suppliers not to charge you VAT or to charge you VAT at 0%. Okay, so if I have that authorization and I'm buying shoes for sale in my shop, everybody else buying the shoes from that supplier will be charged VAT at 23%. When I buy them, I'm going to be charged 0%. Why? I have a section 56 authorization. All I've got to do is give the supplier my authorization and they'll quote my authorization number on the invoice and I'll get them at 0%. Okay. Now, it's a relieving mechanism. I was going to be able to recover that VAT anyway because I'm selling the shoes off to France. I'm charging 0%, and I was in a constant VAT repayment situation. So this Section 56 authorization avoids that problem. Okay. That does come up. This intra-community refunds, this is where it is possible to make a claim for that incurred in a foreign country and have recovery of that VAT without being registered in that country. You can't recover foreign VAT in your Irish VAT return, but if you've incurred foreign VAT and you're not registered in the country that you've incurred, this is not for us people, this is for businesses now. When that business incurs VAT in a foreign country but it's not registered there, the way they can get a refund is via this intra-community refunds referred to as EVRs. So it's an electronic VAT refund claim. Okay. And then this zero rating of services, this is kind of a special rule that only applies to services to foreign suppliers where they're receiving a regular service. So I wouldn't worry about that one. All right. So that's a quick and dirty trip through that. There's plenty of time now. The question that I do want you to have a go at for homework is that megabyte question. I will put up a step-by-step solution before the weekend, showing you how to work your way through that. I expect, unless you've done losses relatively recently, for some of you to have trouble with that. And I will expect then that you will go and do some revision. So by the time that we get around to covering losses, you will be able to build on your foundation, or at least you will have ready the questions for the things that you don't understand. Right. I'm gone 2 minutes, 3 minutes over, but I do believe that I finished 5 minutes early last week, so you owe me 2 minutes. All right. On that note, good night, everybody. Good. Thank you very much, and I'll see you all for the proper start of the course then next week.
Thank you.
Thank you.